The information contained in 4 basic financial statements is of major significance to various interested parties. Ratio analysis involves method of calculating and interpreting financial figures in a statement to analyze and monitor the firm's performance. The basic input to ratio analysis are the firm's income statement and balance sheet. So interested parties to the ratios are shareholders, creditors, and the firm's own management. Firm's shareholders are interested in the firm's current and future level of risk and return, which directly affect stock price. Also, firm's creditors are interested in short-term liquidity of the company and its ability to make interest and principal payments. A secondary concern of creditors is the firm's profitability. They want assurance that business is healthy. Management, like shareholders, is concerned with all aspects of firm's financial position, state. Analysts frequently wish to take an overall look at the firm's financial performance and status. 2 popular approaches to a complete ratio analysis are first, summarizing all ratios and the DuPont system of analysis. The summary analysis approach tends to view all aspects of firm's financial activities to isolate key areas of responsibilities. The DuPont system acts as a search technique aimed at finding the key areas responsible for the firm's financial condition. So, there are 5 categories of ratio analysis. First one is liquidity ratio, that measures its ability to satisfy the company's short-term obligations as they come due. And number 2 is activity ratio, that measures the speed with which various accounts are converted into sales or cash, that is, inflows or outflows. Number 3, debt ratio, indicates the amount of other people's money being used to generate profits. That means company borrows money, and that shows ratio of borrowing in capital structure. Number 4, profitability ratio. It measures the profitability of business of the company. Number 5, market ratio. This measures firm's market value in relation to its current share price. That is, company's valuation in terms of company's stock price. So, first of all, we have to look at the liquidity ratio. This is very important ratio. The liquidity of the firm is measured by its ability to satisfy its short-term obligations as they come due. So liquidity refers to the solvency of the firm's overall financial position, the ease with which it can pay its bills. Because a common precursor to financial distress and bankruptcy is low or declining liquidity, so these ratios are viewed as good leading indicators of cash flow problems. The two basic measures of liquidity ratio are the current ratio and the quick ratio. Quick ratio is also called acid test. So you can get the current ratio and the quick ratio as seen in the slide. Current ratio can be calculated by dividing current asset by current liabilities. Also, quick ratio is similar to current ratio except that it excludes inventory, as inventory is generally the least liquid current asset. Sometimes you can't convert or you can't sell inventory. In that case, you are in a cash flow, you can get into cash flow problem. So quick ratio is more stringent measurement to measure the liquidity of the company. Generally, low liquidity of inventory results from two primary factors. Many types of inventory cannot be easily sold because they are partially completed items or special purpose items or something similar to that. The inventory is typically sold on credit, which means that it becomes an account receivable before converted into cash. A quick ratio of 1.0 or greater is occasionally recommended, but as with the current ratio, what value is acceptable depends largely on the industry. The quick ratio provides better measure of overall liquidity only when a firm's inventory cannot be easily converted into cash. If inventory is liquid enough, the current ratio is preferred. So, second one is activity ratio. Activity ratio measures the speed with which various accounts are converted into sales or cash. That means inflow or outflows of cash. And regarding current account, measures of liquidity are generally inadequate because differences in the composition of a firm's current assets and current liabilities can significantly affect its true liquidity. It is therefore important to look beyond the measures of overall liquidity and to assess the activity, that is, liquidity of specific current account. A number of ratios are available for measuring the activities of the most important current account, which include inventory, accounts receivable, and account payable. The efficiency with which total assets are used can also be assessed. So, there are four major activity ratios. First one is inventory turnover. Inventory turnover commonly measures the activity or liquidity of a firm's inventory. So inventory turnover equal cost of goods sold divided by inventory. Second one is average collection period. That means the average amount of time needed to collect accounts receivable. This is a bit complicated, but you can see the equation. So average collected period equal account receivable over average sales by per day. So that can be calculated as annual sales divided by 360. Sometimes it's 365 is used, but 360 is also commonly used. Number 3 is average payment period. Average amount of time needed to pay account payable. Average payment period equal account payable over average purchases per day. That can be calculated. Annual purchases divided by 360. And number 4, total asset turnover. It indicates the efficiency with which the firm uses its asset to generate sales. So total asset turnover equals sales over total asset. So the resulting turnover is meaningful only when it's compared with that of other firms in the same industry or to the firm's past inventory turnover. An inventory turnover of 20.0 would not be unusual for a grocery store, whereas a common inventory turnover for an aircraft manufacturer is 4.0. So inventory turnover can be easily converted into an average age of inventory by dividing it into 360. The assumed number of days in a year is 360 in accounting. For Bartlett Company you saw in a textbook, the average age of inventory in this case 2003 was 50 days. So this value can also be viewed as the average number of the days sales in inventory. The debt position of a firm indicates the amount of the other people's money, that is borrowed money, being used to generate profit. In general, financial analyst is most concerned with long-term debts because these debts, long-term debts, commit the firm to a stream of payments for a long time over the long run. Because creditors' claim must be satisfied before the earning can be distributed to shareholders as dividend, present and prospective shareholders pay close attention to the firm's ability to repay debt. Lenders are also concerned about firms' indebtedness. Management obviously must be concerned with indebtedness. In general, the more debt a firm uses in relation to its total asset, the greater its financial leverage. Financial leverage is a magnification of risk and return introduced through the use of fixed cost financing, such as debt and preferred stock. The more fixed cost debt a firm uses, the greater will be its expected risk and return. So debt ratio means financial leverage. Financial leverage is the magnification of risk and return using fixed cost financing. Fixed cost means interest rate. Once you borrow money, signing contract, you pay same amount of money, right, every year. So it's fixed cost financing. And fixed cost financing, such as debt, that can be bank borrowing or bonds or some other instrument. There are many different kinds of debt instruments. And also, I want you to look at this preferred stock. Preferred stock, you don't pay interest, you pay dividend. Preferred stock dividend. However, this is not like common stock. It is, I would call it, disguised bonds. It behaves like bonds. So I'll be talking about preferred stock later in the course. And also, debt ratio also means degree of indebtedness. The ratio that measures the amount of debt relative to other significant balance sheet amounts. So we will be looking at this later. So the calculation of debt ratio, the first one is debt ratio, total liability divided by total asset. This measures the proportion of total asset financed by the firm's creditors. Next one is debt to equity ratio. This is the total liability divided by common stock equity. This measures the relative proportion of total liabilities and common stock equity used to finance the firm's total asset. And then, times interest earned ratio. This is EBIT divided by interest. We'll be talking about EBIT. EBIT means earning before interest and taxes. We'll be using this word. And then I will explain how we use this figure, earning before interest and taxes. And then this ratio, times interest earned ratio, measures the firm's ability to make contractual interest payment, sometimes called the interest coverage ratio. So actually, we hear this interest coverage ratio more often than times interest earned ratio. So more common words interest coverage ratio. I hear this word all the time than times and ratio. The another one, fixed payment coverage ratio. This is a bit complicated. Earning before interest and taxes, that is EBIT, plus lease payment, divided by interest plus lease payment plus principal payments plus preferred stock dividend, and multiply by 1 over 1 minus t, and this measures firm's ability to meet all fixed payment obligations. Then let's look at profitability ratios. Okay, this measures profitability, and there are many measures. It enables analysts to evaluate firm's profit with respect to a given level of sales, a certain level of asset, or the owner's investment. Without profit, a firm could not attract outside capital. The owners, creditors, and management pay close attention to boosting profit because of the great importance placed on earning in the marketplace. So there are many profitability ratios. There are 6 major ones. First one is gross profit margin, and then operating profit margin, and then net profit margin, and then earning per share, EPS. I already talked about this. And then return on total asset, ROA, and then return on equity, it's called ROE. So let's look at. So gross profit margin is sales minus cost of goods sold divided by sales. So that means gross profits divided by sales. That measures the percentage of each sales dollar remaining after the firm has paid for its goods. Okay? And then operating profit margin, this is operating profit divided by sales. This measures the percentage of each sales dollar remaining after all costs and expenses other than interest, tax, and the preferred stock dividends are deducted. The pure profits earned on each sales dollar. This means more pure figures. Then there's another one, net profit margin, earning available for common stockholders divided by sales revenue. This measures the percentage of each sales dollar remaining after all costs and expenses, including interest, tax, and preferred stock dividends, have been deducted. And then EPS, we already talked about. Earning available for common stockholders divided by number of shares of common stock outstanding. This means dollar earned during the period on behalf of each outstanding shares of common stock. Then there are more important ratios. The first one is return on total asset. This is earning available for common stockholders divided by total asset. This measures the overall effectiveness of management in generating profits with its available asset. It's also called the return of investment. Return on investment is ROI. In here you see acronym. And then there's another very commonly used terminology, return on equity. This concept, ROE, is you hear often. Earning available for common stockholder divided by number of shares of common stock outstanding. So it measures the return earned on the common stockholder's investment in the firm. Then last one, market ratios. Market ratio relate to the firm's market value as measured by its current share price. So you see this in a newspaper or Bloomberg or stock information website. And giving insight into how well investors in the marketplace feel the firm is doing in terms of risk and return. This reflects the common stockholders' assessment of all aspects of firm's past and expected future performance. And there are two popular market ratios. First one is price-earning ratio, PER, or PE ratio, we say. And then there's a market book ratio, that is MB ratio. But PE ratio is more common measurement ratio we use. So let's look at the market ratio. Price-earning ratio equals market price per share of common stock divided by earning per share, EPS. I just mentioned already how to calculate EPS. And this measures the amount that investors are willing to pay for each dollar of a firm's earning. So if you have to remember some ratios, I want you to remember this. This PE ratio is very important ratio. And then market book ratio. This is the book value per share of common stock equal total common stock equity divided by number of shares common stock outstanding. Okay. So let's look at the market ratio. Some more information I'd like you to know. Price earning ratio, P ratio, as I said, is very commonly used ratio, and it is very important. This is calculated as market price per share of common stock divided by earning per share, EPS. So P ratio equal market value per share, that is stock price you see in the newspaper or website, divided by EPS. You also see that in the information site, stock information site. So you see P ratio also listed in the stock information site or newspaper. And this measures the amount that investors are willing to pay for each dollar of a firm's earning. The most widely used financial ratio. Price to earning ratio, or PE ratio, is the ratio for valuing a company that measures its current share price relative to its per share earning, that is EPS, right? Also known as price multiple or the earning multiple. The high PE ratio could mean that the company's stock is overvalued, or that investors are expecting high growth rate in the future. So either way, it may be overvalued, or maybe market is expecting higher growth in the future. There's another one of market ratio, which is market book MB ratio. This provides an assessment of how investors view the firm's performance. Well, I think P ratio is more commonly used ratio. Market book ratio, book value per share of common stock, total common stock equity over number of shares common stock outstanding. Market book ratio, market price per share of common stock. That means stock price you see in a newspaper or, like news site, the regular stock price, That price, stock price over book value per share of common stock. So this provides an assessment of how investors view the firm's performance too. So if this ratio is large, then a market participants are expecting the company to grow in the future. Same thing for the P ratio too. So financial ratios are very important. However, there is no absolute figures or measurement. They are not absolute figures, which number is good or bad. It depends on the industry. So you look at industry average. For example, Apple, Hewlett-Packard, a computer-related industry. So you compare apples with apples, and then you look at Home Depot and Lowe's, the building material companies, right? So that's the way you actually use those ratios. You compare the numbers with same sort of company, like auto company against auto company figures. Yeah. So the example is here: Whole Food Market, and what one? Sorry, this Kroger, or Target and Walmart, the similar companies. So you actually compare the figure like that. And then if one company's figure is, for example, like a P ratio, it's too high, then you can say the company is overvalued. It depends on the situation, however. So, types of ratio comparisons. So, cross-sectional analysis. So, let's look at types of ratio comparisons. First, we do cross-sectional analysis. Comparison of different firms in financial ratio at the same point in time involves comparing the firm's ratios with those of other firms in its industry or with industry average. So you have to compare apples with apple, orange with orange. You can't really compare apple against orange because each industry has different requirements. So basically conditions or these things are different, so that you can't really compare restaurant with auto companies. So you can also use ratio as for the purpose of benchmarking. Type of cross-sectional analysis in which the firm ratio values are compared with those of a key competitor or with a group of competitors that it wishes to emulate. So there are two types: cross-sectional analysis and benchmarking. Then we have other types of ratio comparisons. Time series analysis. This is evaluation of the firm's financial performance over time using financial ratio analysis, so that you can see the changes over time and compare the performance with the past. And there's another one called combined analysis, which combines cross-sectional and time series analysis. So ratio analysis is very useful. However, it's always relative numbers. You have to compare in relation to other companies in the industry or itself in the past, in the time series case. So combined analysis is like combine the cross-sectional and time series view of American Airlines net profit margin. So this is industry average, right? This red one is industry average. And then American Airlines, you can compare their performance. And then, as you know, American Airlines had a problem. So they recovered and doing very well. However, as other industry, this is industry average. So it's actually deviating industry average, from 2013 to 2014. However, from this point, it's moving or overperforming industry. And then it's underperformed a little bit. So we have to find out what's the problem. So this is the end of week 2-2 PowerPoint. There will be a review test for this presentation, what we have learned today. And please see review test 4 in LUJ Blackboard. Also, the information you learned today is not new to you probably, I think, because you are supposed to learn this in financial accounting course. So I won't be talking about ratios anymore. This is the only time I talk about this. So I want you to do the review test and then make sure you know what current ratio, quick ratio, ROI, ROE, and PE ratio. These are very important ratios.